Good morning, good afternoon, and good evening, everyone. My name is Cassandra Taylor, and I am the founder and CEO of Top Flight Defense Incorporated. And I am here today with a representative from BMO Harris Bank to talk about the basics of banking. So without further ado, I would like, because I don't want to mess up her name. So I just know Ms. Ramos. So I'm going to allow her to introduce herself and get started with the class.
Thank you, Ms. Taylor. Hello, everyone. My name is Yahaida, and today I work for BMO Harris Bank, and today we are going to talk about the banking basics. And with banking basics, you are going to learn how to identify different financial institutions. We're going to talk about the different bank accounts, the different bank accounts that you can choose. We're going to talk about different ways financial institutions protect and insure your money within the bank. And we're going to talk about different strategies to help you protect your money when you're using online banking. So let's begin about thinking about your current financial and banking needs. So what types of places can you keep your money in? So there's 3 different places and 3 different institutions where you can keep and do business transactions. One is with the non-banking financial institution, which is your money service businesses, which is like your check cashing station, places where you go and wire money, like your Walmart, also check cashing places, your currency exchanges, banks. So these are for-profit financial institutions that are federally licensed to receive deposits and issue loans. So BMO Harris Bank, for example, is a for-profit financial institution. Then we have credit unions. So credit unions are non-for-profit financial institutions that are member-owned and operated. So comparing financial institutions, what are some ways that banks and credit unions are similar? So both banks and credit unions accept cash checks, and you're able to wire funds. They're also both able to provide you with loans, traveler's checks, foreign currency, and money orders. They offer many convenient services for US customers. You're able to utilize online banking 24 hours a day. You have access to ATMs where you can withdraw your money. You have access and the availability to get your debit card. And you're also able to open up different types of interest-bearing accounts. Also, both banks and credit unions offer insurance for deposits in certain types of accounts up to $250,000 per person. So how are financial institutions different from credit unions? So banks, they're for-profit businesses. They make money from account fees and interest from loans. Many have more convenient locations than a credit union would. So you're able to utilize more of their brick and mortar branches. They're also open to everyone. So anyone is eligible to apply and open up an account. For credit unions, these are non-for-profit businesses. They share profits with their members. So to have an account with the credit union, you need to either be a member or you might be required to be in a certain type of group or community so you can qualify for an account. With credit unions, they're able to offer you better interest rates And a lot of times, depending on the types of accounts, you're able to get lower account fees if there's fees tied to them. Also with credit unions, they're typically smaller in size, and there's less branches and less locations that you can go to. One example of a credit union would be like the Navy, the Federal Credit Union, USAA, that's a credit union. So how are banks insured? So they offer, financial institutions offer many ways to keep your cash safe, including deposit insurance and other security features. So we're going to take a look and see how it works. So money is deposited into accounts at banks and credit unions. They're insured up to $250,000 for each depositor. That means a joint account is insured for $250,000 per co-owner. So if there's two people on a joint account, then you're insured up to $500,000, $250,000 per person. In the unlikely event that a bank or a credit union would fall, the Federal Deposit Insurance or the FDIC and the National Credit Union Administration for credit unions make sure that you don't lose your money. Keeping your cash at home, even in a safe, doesn't provide you this form of insurance against theft, or if you had a fire or a flood in your home. Not all financial institutions are federally insured, and not all products, just so you know, that are at financial institutions are federally insured. So make sure that you're double checking that the institution and the account that you have is. So there's certain types of accounts and products that are covered by insurance. It covers most types of accounts, like your checking accounts, your savings accounts, and money market accounts. It also covers cashier's checks and money orders. Certain accounts and products that aren't covered are your stocks, your annuities, your bonds, mutual funds, the items within your safe deposit box. Those aren't covered by FDIC or NCUA. Also municipal securities, money market funds, life insurance products. These are also products that aren't covered by insurance. So how does your money grow? So when your money is in a bank or a financial institution, like a credit union, again, a bank, it can earn interest. So what is interest? Interest is one of the most important concepts to understand when evaluating and planning your financial transactions. Interest is a fee paid to borrow money. The banks borrow your money when you're putting it within the bank, and they use that to lend. So it is also collected by a lender and paid to the borrower. When you deposit money into the bank, you are actually considered the lender, and the bank is considered, in this instance, the borrower. That means the bank is paying you money. When you take out a loan from a bank or a credit union, the bank is the lender, and you, the borrower, are the one who's paying interest. So in that aspect, the bank is earning interest from your money. So interest is expressed as a percentage. Financial institutions offer a variety of products ranging from checking accounts to savings accounts to investment tools with different rates that may help your money grow. When you deposit money into an interest-bearing account at a financial institution, your interest that you keep your money with it. So in this case, you're the lender and the financial institution is the borrower. The higher the interest rate, the longer you're going to leave your money in that account, the more money you're likely to earn. So how does interest help money grow? So look at this graph. The bottom part of the bars represent the money you deposit into your account over time. The top part of the bars represent the interest you're going to earn on deposits. As you see, the amount of the interest you earn is eventually greater than the amount of the money you deposit. The concept is called compound interest. So how does compound interest work? So let's say you put $100 into an account that earns 1% each year. So within the first year, you earn $1 in interest on top of the $100 that you deposited. The second year, you're going to earn $1.01 in interest on top of the $101 you had in the bank. In the third year, you're going to earn $1.02 in interest on the $102.01 you earned, and then so on. So because you're earning interest on both your initial deposit and the interest, your money's going to grow over time. So how you owe interest is when you take out a loan and you carry balance on credit cards. So you pay interest to the financial institution. Since interest is always growing, you will owe more than you originally borrowed. So in this case, compound interest is working against you. So when you use your credit card or you take out a loan, the credit card company or the financial institution is the lender, and again, you're the borrower. Credit cards allow you to essentially borrow money for a short period of time in order to make your purchases. Each month you have to pay back the credit card and pay back the lender. So if you pay your balance full in time, you avoid any interest. If you don't pay the amount owed, then you begin to earn interest as well. Or excuse me, you begin to owe interest as well. Similarly, with the loan, you borrow money from a financial institution to pay for something like a house or a car, or maybe even school tuition. You have to pay that back plus interest. So let's look at the different types of accounts to see how interest can affect different goals. So we're going to explore different bank accounts so you can become familiar with these types of available options. So if you're not ready or you don't have enough money to open an account, this is just a great way for you to learn more. And this information is going to help you be better informed. So when you're ready to go in and open an account. So with a checking account allows you to withdraw money and purchase things, your daily transactions. When you're thinking about getting a checking account, make sure that you're looking at the requirements to maintain in the account. So make sure you're checking the overdraft fees. If you were to overdraw on your account, what you're going to pay. See if there's a minimum required for you to keep in your checking account and what the fee is if you fall below. And then also check and see if there's a required balance to open the account. With savings accounts, they also allow you to deposit money and withdraw money. But with the savings account, you're able to earn interest on your account balance. Also with the savings account, when you're shopping and you're looking for different types of savings accounts and you're researching different banks, make sure again, you're looking to see if there's a monthly fee tied to the savings account, what the interest rate is going to be. So how much money you're earning within the savings account, transaction limits. So with savings accounts, they're federally regulated. So you're limited to a certain number of transactions per month. But you also want to check and see if there's a required minimum balance and what the required opening balance is. Here within BMO, just like other banks, with our checking accounts, we offer no minimum balance and no monthly fees for our accounts, and our savings account as well. We have a savings account where you're able to open with no minimum balance and no monthly fees. So depending on the type of account that you have, it could be helpful for different reasons. So we're going to look at what account's going to be best suited for a checking account. So a checking account allows you to deposit and withdraw money, again, for daily transactions. With a checking account, you're able to use checks. You're able to have a debit card. You're able to access 24-hour online banking, or you can choose to bank by phone. Some banks even allow you to do mobile banking where you're able to take a deposit, mobile deposit. You're able to take a deposit of your check and deposit it through online banking. Some financial institutions also let you open an account with as little as $25. Checking accounts are designed for customers for regular use. Some checking accounts do offer interest bearing where you can earn, but on a normal basis, they're typically non-bearing interest accounts. If you were to do a checking account with that pays interest, most likely you're going to have a higher balance required to maintain in the account to earn interest. So a checking account I mentioned earlier comes with a debit card or an ATM card. So what is a debit card? A debit card is similar to a check because it allows you to withdraw money directly from your account when you make purchases at any store or online. These days, it's the easiest way. It'll either have a Visa, MasterCard, or Discover logo on the card. And again, it works great if you were making purchases online or going to the store to make a purchase. And just keep in mind with debit cards, it's very convenient. A lot of times though with debit cards, we've noticed you tend to lose track of your balance if you're not recording what you're using. So just keep in mind that you also want to get in a habit of recording your transactions when you're using your debit card, so that way you can keep great record keeping. Also keep in mind that a debit card is different than a credit card because it doesn't help contribute to building credit. Other features that come with a checking account is online bill payment and automatic transfers to your savings accounts, which can help you stay on top of your responsibilities and making your savings grow. With online bill payment, what that is you're able to, through online banking, pay your bills from online banking. For example, your ComEd bill or your water bill. You're able to plug in the account number. You're able to put in the information from the electric company or water company, and then schedule when you would like the payment to be made. And then the bank will either electronically send it over or mail a check to the company for your payment. If you're saving for a long term and you want to earn interest on your money, a checking account is probably not what you're going to want. In this case, a savings account would be better because it's going to allow you not only to deposit and withdraw money, but it's going to pay interest on your account. With a savings account, again, there's a limited amount of withdrawals that you can do on a month. And if you surpass the limit, banks will likely charge you a fee. If you continue to exceed the limit after being notified by the financial institution, it's going to be required for you to either open a checking account, open another product, or it'll automatically convert you into a checking account. Savings accounts are useful for putting money aside for your wants, for your emergencies, or a rainy day, because again, they're paying interest. With a savings account, you take on the role of a lender because you become the lender and the financial institution is now the borrower since they're paying interest for keeping your money. So there's certain type of specialized accounts. So a money market account or MMA is a savings account, but it's a type of savings account that offers a higher interest rate than that of a checking account or a savings account. With the money market account, you're able to write checks, but you're limited to the amount of checks that you have. Also with the money market account, you're most likely gonna have a higher minimum balance required in that account to earn more money. Then there's certificates of deposits or CDs. These are also savings accounts that pay a higher interest, but unlike a standard savings account, with the CD, your money's tied for a specific period of time, meaning you have to open it with a larger amount, then it'll be locked in for a specific term that you select, and you're not able to make a withdrawal until the CD becomes due. If you do take out prior to then, you're going to be entitled to more fees, and you'll have to pay a penalty. So if you are a young person or you have a young person in your life, there's different accounts for minors. These types of accounts range from checking accounts to long-term savings accounts as well. With a minor account, you have a couple options. You can go joint account, meaning you, the parent or guardian, would be on the account with the minor. Both you and the minor have the ability to make deposits and withdrawals. With the minor, depending on the type of account and the type of and the institution where you open, the parent or guardian might have to give authorization to make withdrawals for the minor. With custodial accounts, the minor is actually the owner of the account. The parent or guardian opens the account in the minor's name, and only the parent or guardian is able to withdraw money from the account. So when you're ready to open an account, there's certain questions that you need to consider. So you need to make sure who the account is going to be for, what the account is going to be used. Is it for everyday transactions? Are you using for long-term savings? If it's a savings account, do you want to be able to access it at any time, or do you prefer to have it grow and leave it for a fixed period of time to earn more interest? If it's a savings account, you also need to know if you have enough money for a basic account, or if you're able to put more money in to earn more interest, you can do a money market CD. So now that we've covered the different types of accounts, interest, what insurance means, how you're covered, what interest means, we're going to do a scenario. And this is Ali. So meet Ali. He has been saving for his daughter's college fund. He has about 20,000 saved and has a goal of 40,000 to save over time. When we're thinking of Ali, he's been keeping his money at home, but recently moved his tuition savings that he left at home into a safety deposit box. So if you're thinking of Ali, what other options would you think he can do to keep his money protected? So in this instance, the best things that he can do would be to either I would say just depending on his daughter, he's saving for her college fund. So just depending on how old she is, when she's going to go to college, I would look at that first to determine what type of product I'm going to open. So if I know my daughter, Ali's daughter's 17, maybe 17 and a half, she's going to be going to college within the next few months. I know I'm going to be writing larger checks. My account's going to go lower. I'm going to need to purchase books, things like that. I might want to do a checking account. Let's say Ali's daughter's 16 years old. So she's got a couple more years to go before she goes to college. A savings account might be better, or even a money market account. Maybe even a CD account, just depending when I'm going to add more money, how often I'm going to add more money, and then again, when I'm going to take out money. So Ali, now we know he saved 20,000, but he still needs 20,000 more to go, since his goal was 40,000 for his daughter's college fund. So he's considered taking out another 20,000 in a loan. He has a bank that's offered him two options. One is a loan at 5% interest for 5 years. The other option is a loan at 5% for 2 years. So let's compare the options below. So option one, the principal amount is 20 years with a rate at 5% and a loan term of 5 years, meaning within those 5 years, he's going to pay off the $5,000 or pay off the $20,000. Within those 5 years, he's accrued $5,000 in interest. So essentially, he's paying $25,000 for the loan at the end of the 5 years. Option B, with the loan amount of $20,000 at 5%, but a loan term of 2 years, meaning he's going to pay off the loan in 2 years. He's only going to owe $2,000 in interest. So which option should Ali choose? In this instance, I would say it just depends on Ali and if he's able to afford the payments. If he's able to afford the payments, then option B would be great for him because he's going to pay less interest. If the larger payments aren't in his budget, then most likely option A is going to be the best option for him. Although he's paying more interest within the 5 years, he's able to still maintain his budget and make the monthly payments because his payments are lower. So it's more affordable for him. So when you're looking at the different loan terms and the different loans that you're looking, always remember interest is going to come into play. So the longer the term, the longer the interest. But then again, the longer the term, the higher your payment's going to be. So always consider your options before you're making a decision to see what's going to be best for you, your family, and your budget. When you're ready to open an account, there's 5 easy steps for you to do. The first is you're going to visit a bank or credit union in person to open an account. Nowadays, you can do that if you prefer, but you can also do it online. You can also mobile banking, like your phone, your computer, you have options to open it online. If you're going into a branch, you're going to need to bring 2 forms of identification, which is your driver's license, your passport. You're going to need also maybe a debit card or some other form of ID to open an account. You're going to need to provide your personal details like your name, your phone number, your address, your email address. You're also going to need an opening deposit. So you want to make sure that when you do your research, you know what the minimum amount is and at least bring that. If you're opening an account and it's going to be a joint account, you want to make sure you're providing personal information for both. So both of you will need to bring in your IDs. When you're opening an account online, the requirements are a little bit different depending on the institution. You may or you may not need IDs. They might have other processes to verify you. For online banking. So anytime you're accessing an account at a financial institution, you want to make sure if you're pulling your banking information that you're using it on a secured site. You want to make sure that you're using your computer, your iPad, your tablet. If you're using a public computer or a public site, you want to make sure that you're deleting your access and you're clearing the history once you leave. When you're at let's say you're at a Starbucks and you're with your computer, you want to make sure that you're not using their Wi-Fi, that you're using your Wi-Fi. When you're selecting a password for your online banking or just any account that you have online, make sure you're using a strong password, that you're using letters, symbols, a combination of numbers. Again, public computers needs to be a secure internet connection. You're logging out of all of your websites after accessing public computers. And then never share your personal information to someone via email or phone. We see a lot of scams and a lot of emails going out or from customers that state a bank is reaching out and they need your account information. We're a financial institution where you bank with, we have that information. So we won't ever ask you to share your account information because we have that. So here's some scenarios that we'll briefly cover just to provide additional information to help you with security and safety. So we're looking at George. He's very disorganized. To make things easy for himself, he uses the same password for all accounts and devices. This is not recommended because if someone was to get access of your information with having the same password for all your accounts and all your devices, it's more likely they're able to get into then all your accounts and all your devices if they're able to uncover your password. With Amira, she creates an account security questions using personally identifiable information like the street she grew up on or the place of her birth name, children's names, children's date of birth. Those are, it's a safety risk. Anyone who again is getting your information or who knows you very well will most likely try to gain that information and knows where you grew up or knows your date of birth and your birth name. So it just makes it easier for them to access that information. Ming loves the convenience of mobile banking and she often checks her account when she's at a cafe or restaurant. In this case, just remember, if I was Ming, I'd make sure that I am using my the Wi-Fi from my phone, not the Wi-Fi from that cafe. And if I am maybe, for example, using a cafe computer, that I'm deleting the information, clearing the history when I leave the public computer. So that's pretty much, skip here and just go over before I back it up. One. So that pretty much covers the difference between financial institutions, how we different institutions are compared, how your money is protected, different strategies that you can do to protect your money when you're using online banking. Within BMO, we have different products that you can open. Again, if you are in need of a bank or if you're interested in our promotion, you can scan the QR code, open up your account online, 2 to 3 minutes. Then you're able to either fund your account at that moment or go in within your branch, the branch nearest you within 60 days to fund the account with at least $25. But with the promotion, we have a couple offers for you. With BMO, we have a great savings builder program where we don't offer a minimum balance that's required for you to keep in your account. There's no fees, but you're also able to earn extra money for having your savings account with us. For any month that you deposit $200 or more into your savings account, BMO is going to give you $5 every month, up to $60 for the first year. With our checking accounts, again, we offer no minimum balance, no monthly fees. Depending on the account that you open, you can also earn incentive with that as well, because we did the workshop and Cassandra was nice enough to have us do a workshop on financial institution and banking basics. And yes, it is very basic. For those of you, a lot of you may know where a checking account is, may know what a savings account is. But those of you that didn't, or maybe your children, would be good to see this video because a lot of teens still may not know what a checking account is, what a savings account is, or what's needed. But on top of that, you also have access to our Smart Progress digital tool here within BMO. And BMO Smart Progress is just additional resources that you can access and you have access to that has different topics. You're a small business owner, you're able to see different topics, different articles to help small business owners. There's different videos that you can view that can help you. There's different, if you have a question on maybe teaching your teen about savings, there's a section for teens that you can access, and it'll help guide you to answer some of help guide you with your teens' questions and just help guide you with educating your teens. So I would encourage you to scan the QR code for the BMO Progress, BMO Progress link, or you can access bmoharris.com/Bank@Work Smart Progress. And we're always updating different articles and just providing additional resources in this link. And then you also have access to my email and my phone number. So if you ever have any questions, any banking questions, please reach out to me. Whether or not you bank with us, our whole goal is just to keep you educated and be here to help answer any questions that you may have. You can reach me via email. It's yahaida.ramos@bmo.com, or you can contact me 620-200-3126. Now I'll turn it over to you, Cassandra.
All right. Well, thank you so very much. That was very interesting. I enjoyed it. I learned some stuff that I didn't know, even though I have been banking with BMO Harris since 1998.
Nice.
Yeah.
So you've been with us for a long time.
Yeah, I've been with you for a minute. Yes, I have. So, but it's wonderful. So I noticed on, I think it was if you go up a little bit, right over the PRQ, where it says apply now. Yeah, you got top flight. So what does that mean?
So top flight, because you were nice enough and you signed our program, our financial wellness program here at BMO. Any of your members, of your community members, are able to take advantage of our offer because we did a workshop with you, and we're going to continue to do and partner with you, just providing different workshops to help the community members get educated. You're able to take advantage, your members are able to take advantage of our offer. So it's exclusive because of you, Cassandra. So everyone thank Cassandra.
So what I'm gonna do, I'm gonna print that page, the 2 pages off, and I'll scan them in and I'll post it on our Facebook page so people will see it, but they will also see it on this video because I'm uploading it onto YouTube. Okay. So let's tell them what class we have going on next month.
So I believe next month it's budgeting.
I think it is.
So
it's the budgeting class?
Yes. So with our budgeting class, you're going to learn to prepare a budget. So with this class, I encourage you guys to join. It's really, unlike the banking basics, we really went to the basics of banking, but with budgeting, we're able to teach you how to maintain a budget, how to create a budget. You're going to find ways to increase income and decrease some of your spending. So I really do encourage you guys to join next month's seminar.
Yep, it's called Strategies in Building Budget.
Yes.
And it's going to be the 3rd Tuesday of November, which is November 15th. And if you sign in with Top Flight on the 3rd Tuesday of every month, you're gonna see her beautiful face. Yes. Yes. And so I wanted to let you know, if you sign up for our newsletter, it's a free newsletter at www.topflightdefenseinc.org. You can sign up for our newsletter. And that way you will get our newsletter every single month. Some months it may come like on the 2nd or 3rd of November. The delay is trying to make sure that I have all of the flyers and everything to our webmaster. But for the most part, everything will be in there at that time. But if you go to our website, it's definitely going to be there if you don't want to sign up for our newsletter. And we're also on all social media. We're on Twitter, Facebook, Instagram, and our YouTube channel. So, and if you follow me on LinkedIn, Cassandra Taylor, you'll see it there as well. So with all of that, I want to say thank you so much. And I'm looking forward to seeing you again in November.
Yes.
Oh, yeah, in November. So thank you. Thank you everyone for tuning in. And I will talk to you later.
Bye.
Bye.